So far, the labor market has strongly supported the U.S. economy. The U.S. labor market stimulates consumption by creating jobs that far exceeded those before the COVID-19 pandemic. Even in the high interest rate environment, wage and prices created a spiral stimulating inflation. But the labor market is now showing signs of cooling. If this trend continues, it is expected that the pace of growth slowdown in the U.S. economy will accelerate next year. Expectations are also growing that the U.S. Central Bank will freeze interest rates at the Federal Open Market Committee regular meeting in December and cut interest rates in the first half of next year. According to the October Job Recruitment and Turnover Report, JOLTS, released by the U.S. Department of Labor on December 5th, local time, the number of job openings in October was 5.7 million, down 617,000 from the previous month. This is the lowest figure since March 2021. It was only two-thirds of the record high of 12 million in March 2022. As the pace of job growth slowed, the inflation rate also showed a gradual decline. Some are predicting that the U.S. economic slowdown will accelerate. The Fed's monetary tightening policy is causing companies to reduce investment and consumers to close their pockets. As forecasts spread that the U.S. Federal Reserve will cut interest rates next year, the interest rates on 10-year Treasury bonds fell below 4.2% per annum. The 10-year maturity U.S. Treasury bonds interest rates, which serves as a reference point for global bond interest rates, closed at 4.902% per annum on October 18th local time. Based on the closing price, it is the highest in 16 years since July 2007. The government bond interest rates, which rose to the 5% range and then began to decline, has begun again. The benchmark 10-year net maturity government bond interest rates recorded 4.17% per annum on December 5th local time, down 0.08 percentage points from the previous day. However, there are also voices warning that expectation of an interest rates cut are too excessive. Investors who bet on an interest rate cut will make significant profits if it materializes, but will suffer a blow if the Federal Reserve continues to keep interest rates high. If the Federal Reserve lowers interest rates, it reflects the poor economic situation. Fed Chairman Jerome Powell recently said that discussion about when to cut interest rates were premature, but given that it was not much different from his previous remarks, it was not enough to suppress the soaring gold price. In a talk held at Spelman University in the United States, Chairman Powell said, if we decide it is appropriate to change monetary policy to tighter monetary policy, we are preparing to do so. However, the market reacted sensitively to signals of the end of interest rate increases in the United States. The recent steep decline in U.S. Treasury yields reflects the possibility that the U.S. economy will decline faster than expected next year. The general decline in U.S. Treasury yields, coupled with the European Central Bank (ECB's) plan to lower its benchmark interest rates next year, and investors' move to eliminate term premiums. In addition, the possibility that the U.S. economy will fall into a recession faster than expected next year is also reflected.